Have you ever wondered why you can't generate consistent profit from the market, despite of how much effort and time you put in to learn? You have studied all the courses out there. You have joined all mentorship classes, but still can't beat the system and generate profit. Sometimes you thought to yourself that the financial market is not real, but when you look back at the chart, you discover the mistakes you made and you decide to give it another try, making deposit and buying pro-frames accounts, borrowing money and loans from credit cards, only to keep losing. The answer is simple. The financial market was designed to frustrate the retail trader. Statistics shows that only 30% of retail traders are profitable. Majority of traders lose money consistently over time. In this video, we are going to uncover the tricks of the market makers, how they manipulate the market and take your hard-earned money away from you. Here is what we are going to cover in this video. Everything is going to be discussed in details. The goal is that at the end, you will not fall victim again for the big money guys. If you want to keep receiving trading videos from us, subscribe and like this video to show your support. Let's jump right into it. The first thing we will deal with is market structure, because this is the foundation of technical analysis. Without a proper knowledge of how the big financial institutions draw their structure, you can't stand a chance in the game of trading. 65% of retail traders still trade the financial markets from the point of a simple market structure: higher highs and higher lows for uptrend, and lower lows and lower highs for downtrend. These are old ways of looking at the market and are not reliable and shouldn't be traded anymore, because the market makers, in a bid to snatch your hard-earned money from you, usually manipulate this structure. The big financial institution knows exactly how a typical retail trader analyzes the market, because they wrote most of the trading books you are reading. Now let's show how the big financial institution manipulate a simple structure before we move over to how they actually draw the real market structure. First, they give you a textbook structure: higher highs and higher lows in an uptrend market. Most retail traders were taught that whenever they see a structure like this, they should buy at the low, that is the pullback. So most traders will pull out their fips and measure the retracement levels. Once price reacts at any of these fifth levels, they will take a buy, expecting price to go up, because they got all the confirmations they needed. A retracement to maybe take 8.2 pips level or more, and a bullish engulfing candlestick on the fibs is all the confirmation they need. The moment you place a buy, they will quickly snatch the price away from you and continue down until all the stops are hit, and even cause some to get margin call. Price will drop as far as taking out the previous higher lows point to make sure that everyone's stop loss are hit. Then price will quickly reverse up and continue the uptrend. Most times, you will notice that the moment price hits your stop loss, it will start going up in your direction. That is because most retail traders trade just exactly the same way, and it's very easy for the market maker to predict their next move and sweep them off the market. Not just that the retail traders who bought here got trapped, but the breakout traders who were hoping to sell the moment price breaks the support level, their sell stops were activated, and after that price moved up, leaving them stranded in loss. Another set of traders who got trapped are the break and retest traders who saw the break of structure, waited for a retest, and so when price went up again, they started selling, but price kept on going up. This is one of the tricks of the market makers, using simple structure. In a downtrend market, they will give you a lower lows and lower highs. The moment a retail trader sees this, they will get excited and prepare to short at any pullback. Of course, price will pull back. Then they will place their sell at any bearish candlestick they see within the zone, not knowing that this is done on purpose to hit your stop loss. The market makers can't take your money if you don't open a position. So they will induce you to take a position by giving you some of the things you read from their books. The moment you place your trade, price will start to reverse up. This happens because a great percentage of retail traders responded to this the same way, so the market makers move price against them. They will drag price to the previous lower highs points, then close above it. Your stop loss is hit. And for breakout traders, they quickly buy, seeing that price closed above the lower high. They thought it's a break of structure. Then price starts to reverse down. Their stops are also hit. Then the break and retest guys are last to get hit. Once they see price come back, they will think that it's a retest, and so they will buy more. Then price will keep dropping more. At this point, all kinds of traders are cleared out of the market. Then and only then do we come into the market. Remember to subscribe if you are new to our channel so that we can keep bringing free trading videos like this. Comment on the topic you would like us to cover next. Understanding these tricks will help you master the real market structure. Now let's look at the components of a real market structure. Market structure does not just comprise of higher highs and higher lows, and lower highs. There are components of a complete institutional structure. For an uptrend market, it begins with a strong low, order block, imbalance, internal and external range liquidity. We will quickly explain these concepts and how to identify them so that you won't have to stress yourself looking for them yourself. Strong low. This is a price point that began the major move in the market. It is the same as higher low in an uptrend simple structure. Strong low, as the name implies, shows that it is a structural point in a market structure. If at any point in time price closes below it, then that is a break of structure. Here is an example of a strong low or a protected low. While in a downtrend, we have a strong high. This is price point that begins a major fall in a downtrend market. It's the same as lower high in a simple structure. If at any point price closes above it, then there is a break of structure on this point. In simple terms, we can say that it's accumulation or distribution of orders formed when institutional traders leave tons of buys or sell orders at a specific price range. But in real sense, order block isn't about orders left behind. It's the big boys using their money to trade against themselves in order to get the small money guys to place a trade. Look at this. Price was trending uptrend. They needed to create an impression that it was going to drop, and so they gave this bearish candlestick. Many traders fell for it, but price continued up. This bearish candlestick in the midst of bullish candlestick is your order block. Here is another example. Order blocks are literally everywhere. In the course of this video, we will learn how to take trades using order blocks. The next component of institutional structure is imbalance. The minute the market maker does a little manipulation and gets the retailers into the wrong direction, they quickly move the market away from this area so that you won't have a chance to manage your risks well. Imbalance candlestick results in margin call. Sometimes they will move the market so fast that it will cause slippage, jumping over your stop loss. This big candlestick and price movement causes inefficiency in market. In every sell, there ought to be a corresponding number of buyers and vice versa. So when the big boys move price in one direction regardless of the balance, it creates inefficiency in the market, which is what we call imbalance. Let's look at an imbalance versus balance market. Here, the gap between candle A and candle C is an imbalance. It shows that there are more of a particular type of order in the market. In a balanced market, candle A and candle C made contact through wicks. A good example here, price made contact through wicks. This is a balanced market. An imbalanced market here, price didn't make contact, creating efficiency. An example of an imbalanced market. Once the manipulation is over and they achieve their goal for the day, he will then go back to fill in the inefficiency. So he will wait for such opportunity and then we take trade the moment it gets filled and ride along. This is an example of an imbalanced market. Got filled, you see how price reversed back. Another example here, price came back to fill it here. Another example here, price came back to fill it here. Now internal range liquidity. Think of it as a price point where majority of retail traders have their stop loss placed. Liquidity means to convert your asset or something into cash. So the point where traders have their most number of stop loss placed are liquidity zones. The moment price gets to that zone, it takes their stop loss and their losses are converted to cash for the big boys. So going back to our example, the point where most retail traders thought was a higher low point and has stop loss placed under is the internal range liquidity. Remember, the only valid point you look out for when considering your structure is your higher low and lower high. Every other thing within is noise. So as long as price does not break above or below this point, you're still intact. So the internal liquidity is given to traders so they can get their eyes off the main structure and focus elsewhere. Any swing point above the strong low is your internal liquidity, while every swing point below your strong high is your internal range liquidity in a downtrend. A good example here. Another example. Now external range liquidity. This is swing highs and lows outside the trading range. From your strong low or strong high to where price reversed from to form internal range liquidity is your trading range. So liquidity outside of this range is your external range liquidity. And let's put everything together and draw a complete structure, showing you how to use each of the components. How to draw an institutional structure. Now we've gotten familiar with the concepts. Let's put them together to form a large picture. The institutional structure begins with a strong low in an uptrend market. Like we said, this is equivalent to higher low in a simple structure. Then we have the order block resting just above the strong low. Then next is your imbalance, which will be filled when the market makers are ready for the big move. Then you have your internal range liquidity, what an average retail trader takes to be another higher low point. This liquidity acts as inducement for the retail traders to take trades, and your external range liquidity here. The area from your strong low to your external range liquidity is your trading range. Never get distracted by the noise in the market. Once you identify this component in the market, you just focus on your trading range alone. In a downtrend market, it begins with a strong high, then your order block, imbalance, your internal range liquidity, where most traders thought to be a lower high, your external range liquidity, and your trading range, which covers from the strong high to your external range liquidity. Let's look at another example. Your strong low, which is your protected low, the only point you look out for, your break of structure. Then your order block, which will be used as your entry point. Then your imbalance. We will expect price to fill this imbalance in the future, so we will use it to add more confluence to our trading. Your internal liquidity and your external liquidity. Another example for an uptrend market. Strong low, your order block, which will be used for entry, and imbalance, internal range liquidity, external range liquidity, or weak high. To consistently generate profits from the market, you must master this concept and their order in the structure. How to trade like the banks. Before any major move, they would want to hit as much stop loss as possible so that you can't profit from it because your win is their losses. So the slogan goes, hit the stops, play the board, and take the ride. You have to make sure that you're out of the market before they start the movement, and so we will want to trade with them. The first thing you will do is to predict what the market maker wants to do to get retail traders off the market. You will ask yourself, if I were to be a market maker, what will I do right here to get retail traders off the market? You will then realize that this zone, which seemed like support, is where retail traders will have their stop loss placed. And also breakout traders will be waiting to see if the support will be broken so that they can go in for a sell. So as a market maker, you would want to get these two sets of people with just one move. Move price to the support, break below it so that you hit the stop loss. After hitting the stop loss, you move price up again and continue the uptrend. Because the breakout traders who had gotten in here needed to be taken out. Now as a retail trader, you would enter in here after the liquidity has been taken out. Your order block is your entry point because that is where your price will end. What makes order block valid is the imbalance, which is resting just above it. So your order block is your point of interest. You enter in when the retailers are all taken out and you ride all the way up. For example, your strong low. Mark out a line to show the trap where retailers will be trapped. Your order block, which is your point of interest. Your imbalance, which makes the order block valid. Price dropped, taking out all the retail traders. Price reversed up opposite again. You enter in here as soon as price tapped into this order block because that is where the bank orders are accumulated. Price moved up and get into profit instantly. Now, downtrend example. First, you have your strong high. This other block will be your entry point, your imbalance, which makes the other block valid. You then mark out your liquidity to show where retailers will be trapped and have their stop loss placed. Then your entry will just be on this other block, your stop loss above the other block, and your target is your external range liquidity. Another bearish example, strong high or protected high, your other block, which is your point of interest. Then you mark out your internal range liquidity. Price take out this resistance level, tap into your other block, your order gets activated, and you move instantly in profit. This is how the big boys trade. Remember, if you've not subscribed, subscribe and hit the like button. Also comment on the topic you'd want us to cover next, as we often look at the comment section to choose our next topic. How to think like a market maker. For you to beat the system, you have to think like the big boys. Always ask yourself, if I were a retail trader, how will I analyze the market? Where will I place my stop loss and take profits? And then ask yourself again, as a market maker, how will I trade so that I take out as much retail traders as possible from the market? Start looking out for these points in the market where you think retail traders will have most of their stops placed. Watch out on how price reacts in these areas. Then learn to enter in once the big boys move start. This of course won't just happen overnight. Practice consistently and you'll get to see the market this way. See you in our next episode.